Welcome to Nothing Exempt. I am Nick Pardini, and I'm with my co-host Brian Piotr, and we have a special guest, Tobias Carlisle, from the Acquires Multiple. He runs the Acquires Fund, and written several value investing books, including the Acquires Multiple, Deep Value, and Quantitative Value. I've read and Concentrated Investment Strategies. I've read two of the four myself, and I thought they were quite informative and a little bit different view than the standard Buffett script that people tend to associate with value investing. So, the first question that I have for Tobias is, what is value investing, especially in a world where you have the central banks as a supposed backstop?
Yeah, that's a good question. And I think that a lot of value investors have been wrestling with it increasingly so over the last 5 years because it's been a long period of underperformance for the more traditional type of value. Simply stated, value is trying to buy at a discount to the intrinsic value of a company. And the intrinsic value of a stock is all of the cash flows that you can take out of it from here until kingdom come, whether it be liquidated or whether it just sort of stumble on forever and ever. Um, the difference between sort of what I do and what Buffett tends to do, and other guys who are even growthier than Buffett, a component of value is growth. So as we get cash flows this year, the idea is that through increasing the size of the business or charging more inflation as a part of it, that cash flows will be greater in the future. This is not true for all businesses. Many businesses we expect lower cash flows in the future, but where the cash flows are expected to be greater in the future and that growth rate is greater than the discount rate, then there's a terminal value in that calculation that becomes quite large. And so the distinction is often between growthier value investors who would put more weight in that bigger terminal value, and guys like me who I don't really trust the very fat terminal values. I prefer cash flows that are closer in time to now, and so they tend to be lower, slower growing, more mature cash flowing businesses. And that's sort of the battleground in the value community is between sort of how much growth you're prepared to pay for. And over the last 5 years, the more growth that you've incorporated in your valuation, the better you've done, and the more conservative you've been, the worse you've done. And that's ahistorical. Typically, the growthier stocks tend to mean revert a little bit down, and the more conservative stocks tend to mean revert up a little bit. But that's basically, it's trying to buy at a discount to intrinsic value, and there are different schools of thought on how it's calculated, and it's the extent to which growth is incorporated into the valuation that sort of determines the difference.
Yeah, so that we live right now in a world where you have at least zero to negative real rates, and possibly that heading there nominally, like in Europe, and the prospect of yield curve control, which I think is in the horizon for the Federal Reserve. And I think that's happened with the Bank of Japan. The bullish counterargument to the favor of growth against value is that if you have any sort of positive cash flow that grows, isn't that make that asset worth infinity if the competing interest rate is zero or negative?
Right. So all of the businesses that I would own at the more conservative end are all free cash flowing in positive territory and growing. So that is true of the companies that I own. The distinction is that the higher growing companies tend to have no cash flows today, negative cash flows today. And the expectation is that once they reach some scale, they become very cash flow positive. But those cash flows tend to be quite a long way away. They might be 5 or 10 or 20 or 30 years away, and then you're paying a high multiple for those earnings in the future. What tends to happen though when interest rates move around, you can think about So the slower growing, more conservative value companies might be more akin to, say, a 10-year treasury, and the higher growing ones might be more like a 30-year treasury where the cash flows are more back end loaded. So as you move interest rates up and down, you can do this in a DCF. You can do a simple DCF for yourself and see this phenomenon. When you move interest rates up and down, the 30-year treasury tends to be more sensitive to interest rates than the 10-year. So as you move the interest rates up and down, the 30-year will move around a lot more. And as interest rates have come down, the 30-year as a proxy for growth has moved up a lot more. And it hasn't seemed to have hit the nearer term cash flows in the value stocks quite as much. You're right, though. If it goes negative on a real basis, negative on a nominal basis, possible too, then all bets are off. I really don't know what happens in that world, because I think that, as you say, things become worth an infinite amount if they can generate positive cash flow. But that should help the value stocks too. It hasn't seemed to so far.
So, how do you personally navigate the world today with narrative being such a strong player on so many of these different, I would say, unicorns? When you are looking at a value stock, do you discount? You look for a non-narrative. It's just a great company that makes lots of money, has lots of very high cash flow, or do you actually, or how where's your edge? How do you take the narrative into account before you invest?
Well, I think the narrative is what creates the distortion between the price and the underlying value, and that can be negative, and that was what creates a value stock, or it can be positive, and that's what creates like a growthy, a glamorous stock. So Tesla might be a good example of a glamour stock. If you look at the fundamentals of Tesla, it's never earned any money. It's negative free cash flowing. It carries a lot of debt. It's a metal bender, so it's a business that requires a lot of investment in factories and manufacturing and so on. It's not like a software as a service business where each marginal sale is costless. Each marginal sale of a Tesla car or truck requires the construction of a factory, which is expensive on a capex basis. Now, I would look at that and say, I can do a fundamental analysis of that company, assuming some investment for capex. Um, Cars aren't a particularly high margin thing to sell, and they're big unit items that it requires a lot of marketing, and it's a hard thing to sell. And I would say that Tesla, this is sort of excluding the brand value of Tesla, just looking at the fundamentals of Tesla, I would assess it to probably have a negative value. And it's managed to survive to this point because Musk is an adept entrepreneur, and he's very compelling, and he's able to raise capital to grow the business, even though, and that's sort of what has kept it afloat. Even though the fundamentals are terrible, the business itself has done okay and has grown, and they sell more and more cars. So I would classify it as, if I look at the underlying business, that's a much more traditional sort of metal bending business that you would expect to be valued as a value stock and not achieve a premium. But because it has a lot of narrative, a lot of glamour around it, a lot of connotations for people who are, the fact that they're avoiding fossil fuels means that for folks who are interested in climate change and so on, it's an attractive way to signal that's your belief. And so it has a lot of non-rational purchases of those vehicles. And it's created this sort of narrative that wildly diverges from the underlying reality of the company. So I would say, I think of it as, it should be a value stock at a low multiple, but it's valued as a glamour stock with a very high multiple. And over time, that will correct.
Yeah, I mean, have you seen what's happened with the recent electric truck IPO, Nikola?
Right, and that's a good example.
It's worth more. It was worth more than Ford yesterday, even though it had
Has
no sales.
Which is my point. So when you look at a real value opportunity, how do you take that into account? Its own brand and narrative and how it's going to affect the market, which is sometimes very irrational.
Well, it's the other way around. So in many instances, it's a very good company that will continue to generate free cash flows for a very long period of time. But the current perception of it and the way that it's priced in the market is either that free cash flow is over, or that it's going to slow dramatically, or that it won't earn any money again in the future. And so when I look at those things and I find a deviation, then that's an opportunity to be long something like that. And there are two ways that that's resolved. It's either resolved in the short term by somebody buying that company at a premium to it, or it's resolved by just time passing. Folks have got very short memories in the market. It takes 3 to 5 years for these companies to sort of work through any near-term problems that they have. Sometimes it's not even a problem, it's just a perception problem, and it's resolved over a period of 3 to 5 years, and then it's hard to remember that it traded at a big discount. You can see it repeatedly with oil and gas stocks, gold explorers, metal benders, whatever is just the flavor of the month is not going to be in a value portfolio. Whatever is shunned at the time will be in a value portfolio.
So that leads me to two questions. The first is there any historical evidence that you've researched to show how many of these growthy names tend to mean revert, or they actually live up to the expectations? Because anecdotally, the only one that seemed to actually live up to the expectations in terms of a negative cash flowing company that turned it around considerably and actually lived up to the hopes of the growth community was Amazon, and Chipotle to a lesser extent. But that's just anecdotal. Like, are there any hard numbers really behind that?
So when you look at the numbers, so we can divide them into just on a price ratio basis. This is very common. This data is all free on the French website, French data library, and French is Ken French, who's one half of Fama French, who have a pricing model for stocks, very famous one. Basically, the very best companies are always expensive, and they have this sort of lottery ticket behavior where if you buy from the most expensive cohort of stocks, you will end up owning companies like Microsoft when it was in very early days, Amazon in very early days, Walmart very early days. You own these companies that go on to win for years and years. But the average experience of that cohort of stocks is that they underperform the market and they underperform value. And the converse is true for value. You don't get as many of these lottery ticket type stocks, but the cohort tends to outperform the market, and the cohort well outperforms Glamour. But that doesn't happen every single year. There are multiple very material periods of outperformance for Glamour over value, and we're going through one right now, and there have been other very famous ones. There have been about 6 that I can count through the French data going back to 1951, and they've all come at the end of long bull markets. So the last really significant one was 1999, and in the run-up to the dot-com bust, Glamour massively outperformed value, and then there was a big crash. The portfolios get reconstituted, and for a period of about 10 years thereafter, it was value massively outperforming growth in the market.
And I wonder, that's the other thing that has just come off the top of my head too, is if you adjust it for market share. So if you picked, say, like the top growth stocks that had like a leading influence in market share, does that change the equation at all, or is that information not really available?
Yeah, so the market share question is an interesting one. So Michael Porter, management consultant, father of Porter's 5 forces. One of the things that he has based a lot of his industry sort of analysis on is this idea of market share, and it's one of the things that's used in antitrust legislation to show that a company has sort of pricing power beyond pricing power that makes it look like it's got some market dominance, like it's able to dictate price to the market. There's actually been no relationship ever found between that market concentration and pricing power or subsequent performance of the stocks. It's one of those things that it's used in court cases all the time, but there's no empirical support for it. So it's one of those things, I don't understand why it persists as much as it does, other than the fact that it's something that you can measure. And even though it doesn't sort of seem to work, it's something you can point to. They make 35% of the sales in this market. They're probably dictating the price.
So and also it's just another value related question I have too is when it comes to a lot of the value opportunities now, they seem to be in the commodity sector, such as energy, base materials such as copper and iron ore, and miners. And my question is, in agriculture as well, actually, is if though is that really a value bet on the commodity being cheap, or is it a legitimate value investment? Because I'm not sure value investing really should apply to something that really is inherently just a levered form of a macro bet on the commodity pricing.
The way that I practice value investing, so if you break down, I don't think about it in these terms. I get there. I've had analyses done on the portfolio. I run this public portfolio in the Acquirers Fund, ticker ZIG. You can grab that fund and you can drop it into any of the portfolio analyzers, and it'll tell you that the first biggest weighting in the fund is to value, and the second biggest weighting in the fund is to quality. I think it's a funny distinction to make, but they do make that distinction in the academic literature. I find it a funny distinction to make because I think it's very hard to find value where there is no quality. And the definition of quality is a healthy balance sheet, robust cash flows going into the business, reasonable returns on invested capital. And it goes on and on and on, things like that you would just say, well, that would just indicate to me that there is some value there, rather than it just being cheap on a price ratio basis. So when I examine those things, in many instances, those companies don't get through my screens because they don't produce any free cash flow. So what I'm looking to buy is something that has a robust balance sheet, generates free cash flow. Often they use that free cash flow to buy back stock because they're cheap, and that tells you that management is aware of that fact and is exploiting it, and you benefit as a shareholder. If they buy back stock at a discount to intrinsic value, it concentrates the intrinsic value that is left over into the shares that remain. So for my companies, they collectively have this phenomenon where the top line grows at about 5%, but the bottom line grows at about 11%. And the reason for that is because they're much more efficient. They're getting to that fatter part of the cycle, but also because they buy back stock. So I look at these things like I'm just ignoring all of the labels, and I'm ignoring the narrative. And I'm just looking at these things as sort of little economic machines and trying to figure out what they do. And so I buy these little economic machines when I think that they're undervalued without worrying too much about the macro backdrop. It's not that I think that the macro backdrop's not important. I think it's incredibly important. I just think it's so hard to predict, particularly in the shortish term. And so I would say that the shortish term is like 3 to 5 years. Which is the period over which I'm trying to invest. I think that in that period of time, often it's micro factors inside the company that matter more than the macro. Sorry, that's not true. The micro factors are more tractable than the macro factors. The micro factors are more understandable over 3 to 5 years than the macro factors, which are often unpredictable. I mean, who predicted COVID? Nobody predicted COVID. Who predicted the shutdown response to COVID? All of these things dramatically change the investment landscape. But when you ignore that stuff, then you're forced to consider what are the multiple paths that any of these companies could take. These companies could go through a period of time where there is a recession or a depression. Could be a very nasty one. Can this company survive? Does it have the financial resources, the financial wherewithal, the robustness in the business? Is the product wanted by its customers enough that they'll continue to buy it through a period like that? If yes, then I consider, well, what's the potential upside here? And then there's a sort of range of outcomes. And if I'm satisfied with any of those outcomes without sort of predicting which one's going to manifest, then I think that that's a reasonable position to put on. So that's how I think about it. I think that that older school ratio value investing should only be practiced really across very broad portfolios, sort of hundreds of positions. And I don't hold hundreds of positions. I tend to hold 30 long and 30 short, much more heavily weighted to the longs, more than 4 times to the longs.
So in the time of COVID, where the market seems to have left any realities and is just going wherever it wants, is this a time where you are very actively trading, or just trying to wait and see which direction the world's going, since your time frame is a little bit longer than anybody can predict what happens?
So I was very active March 20th was the most active day that I've had, which was a few days before the bottom. And I used that opportunity to buy things like I bought Berkshire Hathaway, which is Warren Buffett's company, bought Markel, which is a smaller version of Berkshire Hathaway. I bought Schwab. So all of these companies are the biggest and the best in their industry, best balance sheets run by guys who have a long record of success. For a value investor, something like a recession or depression or stock market crash, I'm always looking at companies that are going through some sort of crisis. That's why they get cheap. They just don't get cheap otherwise. If everything's rosy and good, they're going to be expensive. They only get cheap when there's some issue for the industry or some issue for the company that looks like they're going to have, or the narrative has become so pervasive. So, for example, some of the retailers get the baby is thrown out with the bathwater because everybody assumes that Amazon is going to destroy them, but sometimes there are various reasons why that's not going to happen, and so they become too cheap, and that would be the time that I would look to buy them. So this is just a run-of-the-mill crisis for me. It's the same skill set that I use every other time, which is just to make sure, as I said before, that the company has the wherewithal to survive. That's the most important thing. Without sort of predicting how the company's going to get through this period of time, I just want to make sure that they can get to the other side, or they've got a very long runway to sort themselves out and wait for the industry to come back to them. So that you'll see that often the industries get cheap together. So every company in the industry gets cheap at the same time because there's some macro factor probably or something going on that makes every company in the industry look cheap. I would go through that industry and I'll find the best name at the cheapest price with enough financial wherewithal to make it to the other side. And that's where I'd try and place the bet. So that's all I did this time. Berkshire Hathaway, absolutely bulletproof balance sheet run by Warren Buffett. Generates huge amounts of free cash flow. Depressed because value's depressed, and depressed because there was some question over what sort of exposure they had to coronavirus, to lots of other things that were going on at the time. So I think that you can't lose money on Berkshire Hathaway. The question might be how big the upside is, but I've found that in this business, the upside tends to take care of itself if you focus enough on the downside. So that's sort of how I've approached everything as I've gone along.
So then when it comes to a value position, when do you decide to exit? Will you just sell immediately when it hits fair value? Or do you just maybe tighten the stop and let it run to see if it gets into full growthy attitude?
Yeah, so I don't use stops because I'm reasonably quantitative. I test everything. So if I have an idea, what's the impact of, so there's a famous Graham rule, Benjamin Graham, father of value investing, taught Warren Buffett, famous Graham rule where he said, sell after 2 years or 50% gain. So I thought, well, but Graham's the father of value investing. Buffett's a very famous student of his. I'll test that idea and see if that's a good idea. Turns out selling after 2 years is perfectly fine. That doesn't do anything to sort of impact your returns. Selling up 50% really hurts your returns for the reason that you do get winners that run more than 50%, and you need to be able to capture those returns. So there is this point at which value transitions into momentum. So I tend to hold probably for a little bit longer than, intrinsic value is a range. I look at the bottom end of the range when I'm buying, and I look at the top end of the range when I'm selling. And often it's a pretty wide range because it's hard to nail down intrinsic value with any certainty. So I look to buy below the low end, look to sell above the high end. And often that's a risk question. If I'm looking at something like an airline, that's a much riskier proposition than, say, Berkshire Hathaway. So Berkshire Hathaway, I could let that run for a very long time. An airline, if I get that closer to the lower end of the intrinsic value, it might end up getting sold. So but then at the same time, you've always got new ideas competing for positions in the portfolio. So I find it very easy to fill a portfolio with 30 positions. And then I find that there are a lot of contenders that I would love to have in the portfolio. So often it's sort of selling something a little bit earlier than I would like to because I want to get the next crop into the portfolio.
I guess one other question I have that goes along these lines and talking about industries and value. What do you think about your own industry? Where's financial services going to land on the other side of the coronavirus, and how is it going to affect your both you and Nick? How's it going to affect you guys individually as we go through it?
I think that there's going to be a lot of compression in fees for financial services. We've already seen a lot of that. There's also a lot of fragmentation. It's just that the barrier to setting up your own firm is now virtually zero. You need a license. You need like a connection to the internet and some sort of relationship with a broker like Interactive Brokers. So that's very easy to do. For the fund that I've set up, that's a more difficult prospect. But the fund that I've set up is an ETF, so it's tradable through any brokerage account. It's more expensive to start, it's more expensive to run, but it attracts lower fees too than when. So I run a 130-30 long, short, deep value portfolio. Historically, that might have been able to. You might have got 2 and 20, 2% management fee, 20% carry for that. Nothing like that is available really anymore. It's going to be more like I think the median last time I looked was about a 1.25% fee, and it might have been a 12.5% carry. I don't charge any carry. I just charge a 94 basis point fee, which I think is just slightly getting out in front of where the industry is going. There's going to be compression in fees, fragmentation, but I still think that there's so much. The flood of information doesn't make it easier for people to invest. I think if anything, it probably makes it harder for folks to invest because it's information overload now. It's hard to know where to look. And if you're coming from outside the industry, it's very hard to distinguish between legitimate professional investors and guys who are doing things that are a bit shadier or things that don't really have the backing or the academic or industry sort of backing for what they do. It's difficult for people who aren't pros to sort those out. So I would suggest that they always go through someone like a financial planner or a wealth manager to help them make that decision. But I think that's where the industry is going to go.
Versus Twitter and a Robinhood account?
Well, you can't talk too badly about those guys because they have been crushing it for a few months now. But that typically that ends in tears. We saw that in the first .com boom when the E-Trade babies blew up pretty solidly. So I assume that something like that happens this time around too.
Yeah, I mean, I just think the risk on that is what if the government just decides, like how banks are too big to fail, that the equity market is too big to fail, and it just becomes a guaranteed return of 7 to 10% to keep the pension funds whole. I mean, what kind of distortion would that happen if there was an implicit guarantee built into the financial system to make all the pension funds whole?
Well, if you get that guarantee, then there's no downside and the price rockets to the upside. And I guess we've seen that a lot already. I just don't think it's sustainable. Any volatility suppression always results in a volatility explosion down the line. My buddy Chris Cole is a vol trader runs Artemis Capital in Austin, Texas. He likens it to the redwood forests in just blanking a little bit on the park near me, but in Yosemite. And he says when they don't do the backburning of the tinder underneath, it creates this buildup of fuel for fires. And so when the fires do come through, they're explosive and very, very dangerous. And so the way that you prevent the really catastrophic fires is by having smaller burns every year to get rid of the underlying tinder, get rid of the underlying growth. And I think that that's what having a stock market that has some real volatility in it, true volatility, rather than the suppressed volatility of it that very low rates create. That true volatility makes folks carry a little bit less debt, makes them a little bit more careful about buying companies that have cash flows, a little bit more wary of things that are a bit more speculative. If everything is supported all the time, you're naturally inclined to go for much more speculative stuff and to do it on margin, which then creates its own instability and you get the catastrophic blow up anyway. So I don't think that it eliminates it. I think it just creates a bigger wildfire.
Well, I think, Tobias, you just proved why it's inevitable. Have you seen how California manages its forests? We get a giant forest fire every year.
That's true.
So if the government in DC decides to follow California, that's for sure what we'll be doing here very shortly.
And they're certainly doing a little bit of that now. There's certainly, Epsilon theory has that theory that they've turned the markets already into a public utility, and that's probably why we've seen the speculation that we have over the last 5 years. I don't think that eliminates it though. I think we just get the same old, 2000 stock market got to 44 times on a cyclically adjusted PE. That's the highest it's ever got in the States. Japan got to 100 times in 1987. China got to 100 times more recently. So clearly the market can get more expensive than that. We could see it here again. I don't know. I hope not, because I think that the other side of that is very, very ugly. I think that it would be healthier to sort of have the market come back to a more sensible level for smaller investors who are coming in at this point in their career, rather than older folks who've been in it for most of their lives.
Yeah, I mean, when it comes to that, it seems that the political utility theory, I've read that too. It intuitively may feel that's the case, but it just seems so crazy that it's just fundamentally hard to believe that the world has come to that because of people not saving for retirement properly.
But if there was going to be a year where something too crazy happens, like, this is it.
2020 is the year.
Yeah.
The only thing that would be crazy and unexpected for 2020 now would just be a calm and quiet end to 2020. But I think that that's impossible in an election year. The energy in America gets very, very weird in election years.
Well, I think that actually the scenario, which was my base case prior to the COVID crisis, and I still think has a chance of eventually playing out, would be the inverse of 2017,
And how
where
did that play out?
like you just basically have 2017 was low vol and a straight line for the markets. Like you didn't have like a 1% down move in
Right.
several months. What if we had the reverse on the downside for 2 or 3 years in a row, where you just grinded down maybe 20% on a year on average for 2 or 3 years, or 10% a year on average for 5 years, and it's just a slow grind down.
It's
And
entirely
vol
possible.
drops.
I think that that's possible. The only thing is that every time the market goes down like that, it tends to cascade down. It tends to, once the market starts going down, if you look back through, we've got data going back to like 1850 when it was the Dow Jones average, before it was the Dow Jones Industrial Average. You can look at what happens when, if the market trades sideways or flat for a period of time, the next part of that tends to be, and then it starts trading down. They almost always end in a very violent sell-off. And I guess that's because there's leverage and stuff built up on the system, and folks just can't hold. They become forced sellers at some stage, and that's what creates the cascading selling.
That leads me to like my next question is why, and this is I've been in this industry for about 10 years or so, and the firms that I've worked with or people I know don't heavily use this like in an aggressive way, but why is margin use so high in the first place? I mean, if you have enough beta in the market that you should be able to get returns without going over, say, 2 or 3 to 1 leverage. So why is the margin such a big part of the market outside of a few really speculative day trader types?
Well, I think it just gives you more buying power. Wherever you are, more buying power sounds better. If you're running $10,000, another $10,000 of buying power sounds good. If you're running $10 million, another $10 million of buying power sounds good. It just, there's no end to it, unfortunately. So I think that's, folks like to gamble. Folks like the get rich quick scheme, and I think it's attractive. It's why you see lots of activity and options, because there's leverage embedded in those.
Yeah,
and
but with options, at least you have a fixed premium. It makes more it makes more sense if you want to leverage by paying premium on an option, because
it depends on if you're buying or selling the vol, right? You can short the vol, and you can be taken to the cleaners too.
Well, yeah, that I'm just assuming from a long vol perspective.
Yeah, I think that there's long vol it's one of those things that there's this pervasive idea in finance that you don't want to be a vol buyer because it you overpay for vol. It's just that's the nature of the business. You want to be a vol seller.
Well, yeah, that's the math. 71% of the time, vol sellers win.
Right.
But the thing is, the expected value tends to be zero because when the buyers
Right.
win, they win by a much bigger margin.
100%. That's what I was going to get to. Yeah, it's just it takes a little bit longer. That's Taleb's whole thesis that basically you lose money over an extended period of time, but then you gain it all back in one fell swoop once every 7 years or so, something like that. And that doesn't have to necessarily be on the market either. I like leaps as a strategy, the long-term equity anticipation positions where you buy just a call that's got an expiry more than a year out. And I like to find them in very sleepy value companies that haven't done anything for a decade. Big ones that are generating low cash flow. And what they tend to be companies that are quite good underneath. They're growing pretty rapidly. It's just that 10 years ago, they were way too expensive. And so their stock prices sort of just drifted around untethered for a decade and people have just given up on them. So there's no movement in the stock price. There's no volatility in the stock. So the options are very cheap. The stock is very cheap. And if you've got like 2 years for that position to run, I think you're in a position where something really good could happen. You've just got all of this luck on your side. There could be some vol injected into the options. There could be some movement up in the stock. If you're lucky, you can get both. So you can get some really good returns out of leaps. And you find that there are lots of people willing to sell them to you.
If you have people find out more about what you're doing, can you please tell us where the best way to find you is?
I have a website called acquirersmultiple.com where folks can see screeners of the stocks that I like to buy. We post interviews with podcasts. Sorry, we post podcasts with other investors, and you've been on one. You did a great job. We've got some excerpts from your interview, and the whole thing is posted there. You can see us chatting. I also have a firm website called acquirersfunds.com, and the fund website is acquirersfund.com. Ticker is ZIG. It's long short, deep value in the US, and I tend to be about mid-market, looking to compete with private equity firms and activists and hoping that they come in and create some action in the positions that I hold.
Yeah. Well, thanks for joining us, and we're glad to have you again, especially when things in value start to shift.
Well, it started moving, so it's been about 2 months of pretty good performance. So I'm hopeful that it continues on. But it's been great being on. Thanks, Nick. Thanks, Brian.